Despite the prospects of an escalation in the Middle East conflict, oil prices actually ended last week down by 7%. Joining us right now with more on the energy sector is Daan Struyven. He is Goldman Sachs head of oil research. And Daan, what's happening? The reason that we've seen prices not only do well, but actually come down in the midst of this Middle East crisis?
Yeah, great. Thanks for having me. So really two factors. The geopolitical risk premium priced in oil prices is pretty modest, despite all the uncertainty. And second, I think there are some other factors that have been weighing on oil prices over the last couple of weeks, including higher U.S. rates and a stronger dollar and fears about China demand. And so the question is, why is the geopolitical risk premium priced in crude so modest at the moment? And I think it has to do with the fact that the level of supply disruptions in the crude upstream market remains quite modest, a big difference with shipping markets, for instance. And then second, there is quite a lot of spare capacity that could be deployed if we were to see more meaningful crude supply disruptions.
I mean, a big part of it is the supply situation. The United States has produced much more and really stepped things up. So have a few other areas, like Guyana.
Right. Yeah, that's right. We think that the story of oil markets last year and also this year is demand is pretty firm, coming in higher than expected, but non-OPEC supply is also quite strong and exceeding expectations. And we think that will also be the story this year, although to a lesser extent. We expect demand growth to moderate as the China reopening boom is behind us. And we also think that U.S. supply growth and supply growth from some of the sanctioned producers like Iran will moderate in 2024.
People look at the situation in the Middle East and wonder if we can get back to a 1970s oil embargo sort of a setup where you see massive inflation, shortages that come through. Is that even possible in today's world?
Yeah, so it's obviously hard to predict geopolitical outcomes. Our base case is that Brent will remain in a 70 to 90 range because high spare capacity limits the upside and solid demand. And the OPEC put limited downside. That said, because the geopolitical risk premium is so modest, in other words, the cost of insuring against big spikes is small, and because we still have wars in the Middle East and Russia, we still see value in oil as sort of a hedge against this unlikely but still very meaningful tail scenarios where prices could spike. For instance, in the case of a closure of the Strait of Hormuz, prices would probably double, could rise 20% in the first month and perhaps eventually double if it were prolonged. Not likely, but we think it's worth insuring against these tail risks.
Look, part of it is that politicians may have learned something from those embargoes last time around, too. The American administration, the Biden administration, has said that they're sanctioning Russian oil, but they turn a blind eye when that oil is shipped elsewhere because they don't want gas prices to go up at home and to face that sort of political pressure.
Yes, I think that the energy crisis of 2022 has indeed triggered a political supply response where, for instance, the U.S. administration introduced a price cap which aims to keep Russian barrels in the market while lowering revenues for Russia. We've also seen increases in supply from places such as Iran and Venezuela over that period. And so I do think that policymakers have been very focused on bringing down headline and core inflation and have been pretty successful so far. That said, the uncertainty on the geopolitical front remains very elevated.
As long as you see crude oil prices, I guess you're following Brent more closely, but in that $70 to $90 range that you're forecasting, it still is profitable enough to make it worth the while of either nation states or big oil companies to continue to produce.
Yes, that's right.
If you were to see a collapse in prices, it'd be a different story.
Yeah, that's why we think that in most geopolitical and macroeconomic scenarios, we will be in this what we have called the 70 to 90 OPEC range, which sort of works for OPEC countries, which works for U.S. shale producers, and therefore we think it's an equilibrium.
Anything that would throw you off, it's always the thing we don't know that sneaks up and catches us. Where are you looking for those unknowns?
Yeah, what breaks you out of the 70 to 90 range, right? I think to the upside, shocks, geopolitical shocks that prevent OPEC from deploying its spare capacity. Because yes, there's a lot of spare capacity, but it's all concentrated in a few countries, such as Saudi Arabia and the UAE. And so if you were to see a geopolitical shock that prevents them from deploying that spare capacity for physical or political reasons, that could create a lot of upside. In terms of the downside, I really think you have to see a combination of much weaker demand and a shift in the Saudi strategy for prices to drop sort of below 70 on a sustained basis. And we think that probability is quite low. We think that OPEC Plus is very committed to keeping prices above 70.
Big picture question. Is there such a thing as peak oil? And when would you say we hit it? If we need 15% more than what we have now in 2050, is that left in the ground?
So, there's definitely a lot of oil left in the ground. It all depends on where prices go, right? If you need more production, prices just need to rise.
I'm just talking in a scientific way. How much is Malthusian bets have never worked. We ran out of stones. We run out of stones. That's not what ended the Stone Age. Yeah. We never ran out of stone. Will we ever run out? Would you run out? Could we deplete it to where there was zero left?
No, we don't. We think that's unlikely. If you just look at the reserve life right now, basically you have 16 years of oil left under current technologies and current prices. But technology is likely to improve, and prices could also rise. If the market needs it.